Hello, it's Ashraf Laidi, and welcome to this new edition of the Trade Zone with Eightcap. So there's basically three questions. 1, 2, 3. Uno, dos, tres. Un, deux, trois. واحد, اثنين, ثلاثة. There are three questions. The first question is the US dollar decline going to continue, and are the medium highs or the cycle highs behind us? Number two, is the Fed done raising interest rates? And three is I would say, is the rise in the metals. Is this the big moment? Is gold never going to look back below 1920 or 1930? Is it not ever going to look there? So we're going to answer these questions. But what's important is that I'm starting with this because you probably see a chart that you've never seen before. This is the percentage daily changes, in the S&P, and this is the percentage daily change in bonds. And if you remember, we were looking at the market and we were looking at indices, and I was saying we need to look for the CPI, we need to wait for the CPI, we need to get for the green light of the CPI. Why is that? Because even though we rallied and we started to break out in indices, okay, since last week and the week before, we went up 5-6%, we still needed the CPI, the blessing of the CPI to do that. And indeed, when the CPI came in on Tuesday the 14th, we saw this. Look at this. You see this? 1.9%. The S&P went up 1.9%, and this is the biggest rise since May, and that was the biggest rise since January. So basically, it's the third biggest percentage daily increase in the S&P on CPI day. This was the fourth or the fifth biggest daily decline in bond yields on CPI day. So anybody that says, oh, this CPI is not important, I don't need to wait for CPI, I just heard what the Fed told me. Well, we've seen false signals before. If you've been trading for over a year, you would have seen that we thought that CPI was going to come down. We thought that the Fed was not going to be raising rates anymore, and they stopped, and then they came back, and then they fooled us. And when they fooled us, it's that the numbers were, they showed a renewed rise in the CPI earlier this year after a temporary pullback. So we needed to wait for it. And yes, and when we did get the CPI, it did not disappoint because we have the fourth or the fifth percentage the fourth or the fifth biggest percentage daily decline in bond yields, and the third biggest increase percentage-wise in the S&P, and probably in the Nasdaq it was the biggest of the year. So before we go in the euro-dollar and DXY and dollar-yen and the bond yields, actually I want to go to bond yields because we said time and time again, we talked about the cycle, we talked about the 89-day cycle if you exclude the holidays, but if you include the holidays, 120 days. And basically, we said that each time we peaked here on March 3rd on the Silicon Valley Bank, on July 7th, okay? These are not coincidences. July 7th, 7/7, March 3rd, 3/3. And then the next peak was going to be this week. And it was not a peak, but it was a big decline. So it was an inflection point. And when that happened with the CPI day, okay? So let's just briefly talk about just the indices. So it seems that 15,600 in the 15,600 in the Nasdaq is gonna be some sort of major support. Okay, I would say 15,600 before we go to 16,000. And actually, for the S&P, we did tell the group we were looking at these levels. You remember we were talking about a quadruple or a quintuple resistance. We were talking about a quintuple resistance in the S&P being 4402. Well, we knifed through it, and the next level was 4460. And when we knifed through it, we basically told the group that we're going towards 45.6, 45.7. So this is really the key level right now. Okay, so 45.10 is still a big resistance here. There is really nothing else to play for except probably 45.40. When you hit these levels, you don't need to produce or generate trades. If we're done with the intermediate target, we're done. Let me just give you an example. Do you remember we were $1 here? Basically, we were saying in the video, we were saying, oh, when the market is ready to move, then it will move. Okay, we're saying when the market will move, when it is ready, not when your account, not when your margin account, not when your trading account, it's when the market is ready to move. It was a nice formation here. It was a nice formation here. It was a nice formation here. But yes, you can fall in love with the, inverted head and shoulder and so on and so forth. But, you just need to wait for it to break out. And this is what we saw, and finally it broke out, okay? And basically, so once again, we were looking at this, yes, inverted head and shoulder, we broke above it, we came back to the neckline, we went above the neckline, we went below the neckline, and then finally the key levels were always these two, and were always these two, which is the 100-day and the 200-day, which is around 108. So for now, if there is a trade to take, for me, I would say that 109.70 or 110 is a big resistance, and I'll tell you why. So basically, some sort of support here. If the support is the previous resistance around 108. So if you want to put a stop, if you want to go long around 108.50, you put a stop below 107.80, and you target 109.80. Why is that? 109.80 just close to 110, and here is the meaning of 110 if you look at the weekly chart. Okay, so basically the weekly chart, even though the 200-week moving average, which is the yellow, is 111.55. You will see that you have sort of an intermediate high around 110. So you don't target 110, you target 109.75. So basically it's 120 pip above the current level, and you have around 50 to 60 pip or 40 pip stop if you want to do that. Or you can have multiple entries. You can have two entries. You can enter now, and you can wait a second entry on the pullback on 108.30, so your stop will be less. Okay, so this is the key here. Regarding gold, I'm not going to show you a chart of gold. I'm going to show you a chart because everybody shows a chart of gold. I'm going to show something different here, which is I'm going to look, the question is gold ready for the breakout? And we had a trade, we had two trades for the WhatsApp broadcast group. We had one around going long around 1960 and put a stop around 1955 or 56, and we got stopped out. And then we said, okay, we're going to go to 50. If we're going to put a new buy order around 54 and 55 because it was a low from November 7th. But the key metric you want is this. I want copper to go above 8,300, but I really care about silver. Silver acted as a key metric for a support, as a key reference point for the support. And now I'm looking at 2380. I want 2380, 2390 to break higher. If you want to know something, silver is very important because the inverse relationship between silver and gold and silver and the dollar is deeper and bigger than that of gold and the dollar. Okay? So you need to break above 2380, 2390 to give you the green light. And that's why I said many times the gold to silver ratio is a good metric with the dollar. But one thing that you will need to look at, this is a very easy thing. You can go to TradingView, you can go to the internet, and you can put a chart of the XME. The XME is the ETF, of various metals miners, okay? And the level that you want to break above 53, 54, that will really increase the confidence that metals are going to push higher. And what I mean by that, if you look at this, if you go to the XME chart here, and of course, you're trading gold. If you have enough clarity with the metrics of gold, if you think that as long as gold remains above 1950 or 1948, then we are going towards 2000 and so on and so forth, that's fine. But here is what you need. Do you remember this? This is the moment. So spring 2020 is when everybody was putting a blindfold and they were selling the dollar and buying gold and buying metals. Spring 2020, meaning April, May, June. Okay? But the key level here is that 2020, the XME here started to rally, and then finally it just broke out with the help of the stock market. Because again, the XME is not bullion; it is actually the companies that make the bullion. So as stocks went up, it had the stock part of the stock market part of the metals. So what you want to be basically breaking above 54, 55 to have the stock market confidence of the metals market. Okay, and so we spoke about the yields. We spoke about the dollar yen. The Bank of Japan never had to lay a finger to intervene because the CPI came in and it did its work. And it seems that here, that all these bouts, all these sudden declines, you need to look at the 21-day moving average. Okay, so when we had a short run, we basically told the group, listen, we have nothing to lose. Just put a stop around, put an entry, and I mentioned this in the previous video. Put an FDON order short around 151.80, 151.90, and target around 148, and then we changed it and we said, no, let's do it above the 21-day moving average, which is basically around 150.20. 150.20 right here. And we did, so it serves as a big support on a closing basis. That means you can break it intraday, but you can respect it. So I think there's a very good chance that 151.21 will go back towards 150.50, 150.60, okay? Today, we've got the jobless claims and we've got the Philly Fed survey. The sentiment that is good for the indices is that you finally have the Chinese president and the U.S. leaders and Xi, who are basically talking. So that is definitely a positive for tech. So we spoke on dollar yen, we spoke about euro dollar, we spoke about gold, we spoke about the euro dollar. And if you look at indices here, if you look at the S&P again, basically what we're looking at is that this was a trend line resistance. We broke above it. It's just going to be a matter of time. There is a series of up gaps here in all major indices, and that's really a powerful signal. So it does seem that, 45.90, even 45 or 4600 should happen here. And the second half of November, which just started today, is really going to be one of the most powerful, seasonally speaking, sort of 2 or 3 week period in the market, and probably even bigger period into January, into February. Okay, so this is really what we are looking at here. Just one last thing, which is basically Aussie dollar. They had some strong numbers. Aussie dollar and euro dollar are still a good choice, but I think euro dollar would probably be the preferred. One last thing, which is euro sterling, which was probably the best trade for me last year. I spoke about this in my video a long time ago. I did a video on this with a channel, Real Vision. I don't know if you know about Real Vision here. So it was October of last year, and it was one of my best trades here, euro sterling. And if you look at this, is that we've broken above the day moving average. So let's just, if you look at the fractal of the monthly chart, you'll see what is happening right now is very similar to what happened in 1990s. It happened in 1991, 1992. It was basically when sterling crashed because of George Soros, when he bet against it. But right now, we broke above the 200-day moving average series of time, and we stayed above it, the 200-day moving average in the yellow. And so even though we think that 88.80, 88.90 is still a logical target, you don't want to buy here at the top and expose yourself. As much as possible and as positive and as confident you are on the pair, I think that you don't want to buy here around 87.50. There's said to be some options barriers here. So you want to wait for 87.30, 87.20 to come back. But this is still going higher because of the fact and the expectations that the European Central Bank is expected to be actually not raising rates anytime, not cutting rates anytime soon. And probably the Bank of England is closer to cutting rates. Okay, so this is the one to approach it cautiously. Thank you very much, and talk to you next week.